Thank you, Nora, for that generous introduction. I appreciate the hyperbole. Thank you, Allison, for inviting me to be here today. Thank you to the journal staff for putting together this great conference, and thank you all for staying here on this beautiful afternoon. It is cold out there, though. Probably wise to stay in here for a little longer. Yeah, it is not an upbeat message. If you're really serious about corporate social responsibility, it is hard to be upbeat. And I'll get to why I think that. I think the reasons maybe are a little less obvious. It's not really a problem of corporate law as such. And I'm going to be talking about this from the corporate law perspective, because I'm not an environmental lawyer or a labor person. Well, let me launch into this. I do see, as we all do, that corporate social responsibility is a potential solution to the water quality problem, to environmental problems more generally. And what we're talking about here with the key idea behind corporate social responsibility, as I understand it, it's voluntary action. It goes beyond compliance with law and regulation. Okay? And my view is that corporations have a lot to do, a lot that they could do of that nature, and many are doing a fair amount already. They could all do a lot more. The problem with doing more than the law requires is that it generally costs money, and what that means is lower profits and lower share prices and less wealth for shareholders. So there is a fundamental tension here between corporate social responsibility initiatives on the one hand and shareholder wealth maximization on the other. And the view of corporate law and corporate purpose that emphasizes shareholder wealth maximization is often referred to as a shareholder primacy idea. I may use that term from time to time in this talk, in distinction with corporate social responsibility, which means companies should attend to social problems and try to create social value as well as shareholder value. And so what I want to focus on, the general point I want to talk about here, the general topic of this speech, is the prospects for CSR in this area, and really more generally, because everything I'm going to say is relevant both to environmental sustainability and also to other issues and many other ways in which companies act irresponsibly could do better. And at the end of the day, just a preview, I'll give you a roadmap in a second because there's no PowerPoint. My point on why my thinking about the prospects for CSR is not terribly optimistic, surprisingly maybe to some of you, is not a matter of corporate law. Corporate law is not the problem here. I think it's really market pressures, and particularly pressures from big shareholders for short-term profits that is the big problem. And that's a hard problem for reasons I'm going to try to explain a little later. Okay, so let me just orient everybody, because there's no PowerPoint. At my age, there are many things that I've realized there are many things I'm never going to learn, and that is one of them. But I'm embarrassed because everybody else did these great PowerPoints with graphics and all this stuff, but I can't do that. So 3 points. First point, I'm going to talk about corporate law and corporate social responsibility. And the key takeaway there, and this is really important for everybody to understand, is that existing corporate law gives companies broad leeway to attend to environmental considerations, other social values, even where that means lower profits and less wealth for shareholders. Okay, first point then, CSR and corporate law. Second, I want to talk a little bit about what we mean by CSR. I'm going to sketch two different models or ways of thinking about CSR and suggest that the prospects for CSR may depend, at least somewhat, on which model or theory of CSR you have in mind. Okay, and then the third subtopic here has to do with the current business environment and the reasons why, the non-legal reasons why, prospects for corporate social responsibility, I think, are somewhat, I wouldn't say dismal, but they're not that encouraging. And this has to do with the power of institutional shareholders to put pressure on management to maximize quarterly earnings. Okay, so first topic then, corporate law and CSR. And again, the key idea here is that corporate law gives companies very broad leeway to attend to social good if they want to do that. So let me talk a little bit about law now, since we are here at the law school. First, about 40 states now have statutes that are called constituency statutes. And the basic idea here is simple. These statutes expressly authorize management of corporations to take non-shareholder interests into account. If you focus only on shareholders, you're focusing on maximizing corporate profits in order to maintain share price. These statutes say you don't have to do that. You are allowed, not required, you're allowed to attend to other non-shareholder interests, like the interests of workers, like the interests of local communities in which companies have a presence, consumers, suppliers, creditors, and also the environment. For example, the Pennsylvania statute, which is typical of these constituency statutes, says that corporate directors are allowed to take into account the interests not only of shareholders, but also of, quoting, employees, suppliers, customers, and creditors of the corporation and communities in which offices or other establishments of the corporation are located. And if that weren't clear enough, the statute then goes on to state expressly that directors are not required to treat shareholder interests as, quote, dominant or controlling, close quote. So this is an express statutory repudiation of the idea that management's job, first and foremost, is to maximize profits for the interests of the shareholders. And as I said, there are about 40 states that have one of these statutes right now. And so if a company is incorporated in one of these states, it already has very broad statutory authority to engage in CSR policies if it wants to do that, without fear of liability from the shareholder based on the shareholder lawsuit. What about Virginia? Well, Virginia doesn't have one of these statutes. But even in Virginia, the prospects are still pretty good if you are a Virginia company that wants to adopt CSR policies of some kind. The statute says, the Virginia corporate statute says that, quote, a director shall discharge his, they really mean is his or her duties as a director in accordance with his or her good faith business judgment of the best interests of the corporation. So the duty is to the corporation, not to the shareholders. That's important in itself. But more than that, the business judgment rule, as it is applied in Virginia, protects board decisions about what the best interests of the corporation are from judicial scrutiny, judicial review, as long as those decisions are based on adequate information, the board is fully informed about the matter at issue, and as long as the board decision is untainted by any conflict of interest. If those criteria are met, adequate information, no conflict of interest, there should not be any judicial review of a board decision based on the substance of that decision. And importantly, there is no requirement, expectation, that directors will actually prove that a particular decision is in the corporation's best interest. So, for example, take a simple example. Suppose you have some hypothetical consumer products company that wants to spend money on an environmental project that is not required by law. It's going to require cash expenditure, and the purpose is not to generate more profit down the road. They're doing it because they want to do the right thing. But the directors say, yeah, we want to do the right thing, but we also think that down the road this is going to generate reputational benefits for the company, goodwill among consumers, goodwill among our employees. And eventually the board says, we think that this initiative will result in higher sales. Can they prove a claim like that? Probably not. There's really no way you could. But the important point is they would not be required to. As long as you can make the claim of reputational benefit, enhanced goodwill, with a straight face, as long as it's plausible, and as long as your decision was based on a sound decision process, adequate information, no conflict of interest, you're going to be fine. So What does that mean? It means that directors who want to embark on some kind of environmental or other socially motivated initiative can do that as long as they can say with some measure of plausibility that, in the long run, the corporation will derive reputational benefits. And that's really all they have to say. And that gives you a lot of freedom if you are a Virginia corporation. Now, what about Delaware? We need to mention Delaware because close to 2/3 of the biggest American companies are incorporated in Delaware. Delaware doesn't have a constituency statute either. And maybe surprisingly, there's significant disagreement about whether Delaware law actually requires shareholder wealth maximization or whether instead it allows CSR policies at the expense of shareholder wealth. There's not much legal authority, there's very little, almost no legal authority for the view that Delaware law requires shareholder wealth maximization. The statute doesn't say that. The statute expressly allows incorporation for any lawful purpose. The Delaware Supreme Court has never said that corporations have to maximize shareholder wealth, except in a very narrow situation defined by a case called Revlon, and that's a situation that management is free to avoid if it wants to do that. Even given the absence of legal authority for the shareholder wealth maximization view of corporate purpose, though I have to admit, it's still widely assumed by business leaders and a lot of corporate law academics too, that Delaware law does require shareholder wealth maximization. But even for these people, they talk in terms of the long run, rather than some kind of a duty to maximize profits on a quarterly basis. And once you put it in terms of the long run, that really does, it probably comes close to letting all the horses out of the barn. This is because it would allow you to adopt something like the hypothetical initiative that I mentioned a minute ago that's justified in terms of long-run financial benefits, maybe based solely on reputational considerations, that can't be monetized. And importantly, the business judgment rule in Delaware, as in Virginia, means that a board claim that in the long run the corporation will be better off here is not going to be scrutinized, it's not going to be second-guessed. There's not going to be any requirement, in other words, that they actually prove that a certain amount of profits will be earned, in the future as a result of these reputational gains. So, key point here, I think, is no matter what state you're in the U.S., corporate law leaves a lot of room for corporate social responsibility. You've got the states with the constituency statutes, in which it's wide open, and then even the states that don't have those statutes, the way the business judgment rule works is essentially to insulate board decisions from judicial review as long as they are adequately informed, not tainted by conflict of interest, and can make some kind of plausible claim to long-run benefit to the corporation. Okay, so that's the good news, and I think that's really important. It's not generally known that corporate law actually does. It doesn't require anything resembling corporate social responsibility, but the key point here is that it leaves a lot of space for corporations that are inclined to do this sort of thing. Okay, now, moving on, I want to talk a little bit about second point, my three-part outline. I want to talk about two different models or theories or ways of thinking about corporate social responsibility, and then suggest that the prospects for corporate social responsibility may differ depending on which model you have in mind. Okay, the two models I have in mind are, I've labeled them first the ethical CSR and second strategic CSR. Ethical CSR means this. The key idea is that corporations should take into consideration their impacts on society, the interests of non-shareholder constituencies when formulating business policy. This could include workers, consumers, local communities, and also the environment. That they should do this not for financial considerations, but simply because it's the right thing to do. And there are lots of ways, I won't go into this, but there are lots of arguments that can be made in support of that view. For example, corporations are very powerful. They generate a lot of external effects. In pursuit of profits, they have they pose a lot of costs on society. And you could argue that they ought to internalize those costs. So you have ethical CSR, then the idea that corporations should engage in corporate social responsibility because it's the right thing to do. It's nothing to do with dollars and cents. I want to contrast that with a different model of CSR, which I labeled a strategic model, or strategic CSR. And the idea here is that corporations can engage in business policies and practices that benefit non-shareholders to the extent that corporate profitability and therefore shareholder wealth will be enhanced in the long run. Let me give you a couple of examples of what I'm talking about, okay? And there's lots of examples. I just picked a couple kind of randomly because they're good examples. Nestle, the Swiss global food products company, does a lot of things. And one of the things they wanted to do, produce milk and then they sell it. They wanted to increase milk production in India, in their facilities in India, or in communities in India where they had a presence. And so Nestle made big investments locally in irrigation, well drilling, refrigeration, veterinary medicine, training local population in animal husbandry. All of that resulted in more output, more milk being produced, and better quality milk being produced, and of course that translated into higher profits for the company. But at the same time, it also enhanced the quality of life of the people who are actually there on the ground. It meant better incomes for them. They're making more money. Their better educated quality of life improved. So that piece of it, the benefits to the non-shareholders, in this case the people who are actually producing the milk, you can think of that as a CSR type initiative because you're doing good for non-shareholders. But at the same time, the company's initiative is really motivated by the desire to make more money down the road. Another example, Federal Express has invested a lot of money in more energy efficient airplanes and trucks and in computer software to improve scheduling efficiency of the delivery stuff. Benefits to the environment in the form of reduced emissions. So that's good. That's a social good. So you can see this as a CSR type policy. But at the same time, the company saves money, lower energy costs, and therefore higher profits. Okay, so both, and the idea here is that companies like these are engaging in what we could think about as CSR type policies, beneficial to non-shareholders in different ways, but for the sake of enhancing profits in the long run. You lose money in the short run because this stuff costs money, but the notion is that in the long run the company will make more profits than it otherwise would have, and the profits down the road, future profits, will offset the current expenses involved in these sorts of activities. And this is referred to in the literature as, quote, the business case for CSR. We're not talking about doing CSR because it's the ethical thing to do or the moral thing to do or simply the right thing to do. We're talking about engaging in CSR type initiatives because in the long run the corporation and the shareholders will make money. So what are the prospects for either version of CSR in the current business environment? I want to shift to the third and final point here. Here, I want to focus on the role of institutional shareholders in shaping corporate behavior. Retail investors are people like us, and there still are some of those left who want to buy shares in companies, trade in their own name through a broker or online or whatever. Institutional shareholders, for the students, are gigantic institutions that own lots of stock in publicly traded companies. And institutional shareholders as a class, I don't know, the number keeps going up, own something like 70% of the stock market, 60 to 70% of the stock market. Some companies, the institutional shareholders may own 80% of outstanding shares. They're big players in the stock markets right now. Who are they? Institutional shareholders would be the biggest, are the big pension funds, especially the public ones, like the California Public Employee Retirement System, which is the biggest of them all, CalPERS. And these are the entities that provide retirement benefits to public employees, policemen, firemen, teachers, and the like. And so they've got massive amounts of money to invest, and they invest massive amounts of that money in the stock market because they want to earn returns that way. And over the long run, you do better in the stock market than in with other kinds of investments. So you've got public and private pension funds, you have insurance companies that have all these premiums we pay that they don't like to pay out in the form of claims. They are invested in the stock market. Mutual funds are heavily, lots of mutual funds are stock funds. A mutual fund is a basket of shares in different stocks, and then individual investors can buy pieces of that pie as opposed to investing directly in the stock of individual companies. Bank trust companies, university endowments, lots of big players out there in the stock market now, much more so than was the case 20 years ago. Now, so that's who they are. Now, what's my point with respect to their role in the CSR arena? The point here is that certain categories, important categories of institutional shareholders, put a lot of pressure on big corporations to maximize short-term, which I mean quarter-to-quarter, profits. Why do they do this? Well, take the pension funds first. It's often thought that these shareholders, pension funds, are the ultimate long-term investor, patient investor, because they've got to worry about paying out retirement benefits to workers, decades into the future. And that's true. They do have to have that always in mind. But what's often overlooked is that these pension funds have massive current obligations to people who are already retired. CalPER's the big one in California, and all the rest of them have to write checks every month to people who are already retired. And that's a lot of money. So they have massive demands, current demands on cash demands. And what does that mean? It means that it leads these companies to put pressure on corporations in whose stock they have invested to maximize short-term profits in order to maximize current share price so the pension funds can earn profits on their stock portfolios. And historically, pension funds in their planning have expected to earn something like 8% a year on their investments, and over a 30-year time horizon, historically we've been able to do that, but of course you can't right now, post-financial crisis. Well, you probably can. In the last few years, it's been a big run-up. But that's uncertain. So anyway, key point on the public pension funds and private ones as well, run by big companies, have heavy demands to generate current income in order to meet their own obligations. And one of the ways in which they do that is by putting pressure on corporations in which they've invested to maximize quarterly earnings. You also have mutual funds, certain mutual funds, a lot of mutual funds that are invested in corporate stock compete for investor dollars on the basis of short-term performance. So every year, at the end of the year, Wall Street Journal will publish a table of all of these different mutual funds, and it'll rank them based on how they did during that most recent year. And investors, there's studies about this, pay attention to that. They're not worried about long-term results, they're worried about the short-term results. How has this company done? How's this fund done in the last year? And that means that the people who manage these funds are under a lot of pressure to generate strong financial results on a short-term basis. And they're making investment decisions on that basis, and that means they're putting pressure on corporations in which they, the fund managers, are investing investor money to generate strong quarterly earnings on quarter after quarter. And I think those are probably the two most important classes of institutional investors with respect to the phenomenon I'm talking about now, but they're two of the most important ones in terms of the amount of money involved, the amount of money they have under management. Okay, so what does that mean for CSR? What is the fact that a lot of these big shareholders, institutional shareholders, are putting pressure on companies to generate short-term profits at the expense of long-run value? What does that mean for CSR? Well, for ethical CSR, I think it's pretty clear these investors are not going to tolerate corporations sacrificing current profits for non-financial considerations, like the well-being of workers or the health of the environment. Shareholders who are fixated on short-term profit maximization are certain to object to policies like this because they cost money, and they're going to reduce your bottom line in whatever quarter the money is spent. Especially if these expenditures, and that's in the case of ethical CSR, especially when these investments, these expenditures are not justified by generation of additional profit. Even if objecting shareholders have no effective legal remedies, and they probably don't, a company, I said this earlier when we were talking about corporate law, right? A company that chooses to, for ethical reasons, to embark on some kind of CSR initiative that's going to reduce profits without any prospect of offsetting gains in the future, well, I said the business judgment rule could protect you from that if you make some kind of, at least straight-faced claim that there would be some corporate benefit. So it's not really the threat of a lawsuit that pressures management to prioritize short-term profits. It's really the threat that a lot of these shareholders, when they talk to each other, they have advisors who pay attention to all this stuff, could join, several of these large institutional shareholders could join forces and together could use their voting rights under corporate law to replace incumbent management, or at least threaten to do that. Even short of that, if a lot of these institutional shareholders who are like-minded in the sense they're all focused on quarterly results, quarterly profits, simply decide to sell their shares because the company didn't do as well that quarter as these investors thought it should have done, these large-scale sell-offs are going to cause the market price of the stock to fall, and that will result on pressure on management from the other shareholders who haven't sold their shares. So, even though the law isn't a very particularly powerful lever here, there are market-based levers that allow these big shareholders to punish companies that don't achieve suitable short-term financial results. So for companies that are motivated that way, it's very hard to imagine ethical CSR being an attractive strategy for a company. There's no real reason why it would do that. And I think one of us, I think Jeff said earlier that form, ethical CSR, really is not really part of the picture for most big companies anymore. And I think he's right, and I think it's probably because of this phenomenon. Investors won't tolerate it. Now, strategic CSR is different, right? Because here the idea is you engage in CSR policies with the express intention of generating additional profit down the road that presumably will offset your expenditures on workers or the environment or whatever. That ought to be more palatable to shareholders who care about, who are fixated on the value of their stock, because at least there are promises of long-term gains that will justify the short-term expense. But there's a big problem here too, and this is a problem of timing. Strategic CSR, just like ethical CSR, requires current expense. So if you want to buy, energy-efficient vehicles, or FedEx did, or if you want to invest in India and milk production, all of that costs money right now, and that's going to have an immediate effect on your earnings and the account, your profit, your bottom line of your income statement in the quarter in which those expenses are incurred. The benefits, the financial benefits, if any, are only going to occur down the road, maybe several years down the road in some future accounting period. And for many large institutional shareholders, the whole point is that they're not willing to wait because, again, they've got immediate demands for cash. Pension funds have to write those checks, and mutual funds are competing for investor dollars on the basis of short-term performance. And so the prospect of future gains down the road is really not of any great appeal. If you're talking about current expense, it's going to reduce profits now and potentially negatively affect share price. So in order for companies to feel free to pursue even strategic CSR, institutional shareholders would need to be more patient. This is what I mean. The title in the program says I'm going to talk about shareholder social responsibility. Well, having now talked for over half an hour, I'm about to say something about shareholder responsibility. And it's simple. The problem is for certain important classes of institutional investors, they're not willing to wait. They're not willing to allow companies to invest in CSR, even when that will mean larger profits down the road, because of these pressures that they are under. And so, from this perspective, if you're really hoping for corporate social responsibility, you need a measure of shareholder social responsibility. They need to be willing to change their outlook, to change their priorities, to change their values, take the pressure off companies to maximize profit right now and allow them to make investments that are going to pay off down the road. By the way, we're not just talking about corporate, so we're talking about research and development, we're talking about marketing, we're talking about capital investment, we're talking about worker training, all kinds of programs that have nothing to do necessarily with corporate social responsibility, but are very important for the long-term health of individual companies and really for the long-term health of our economy as a whole. There's a lot of empirical data to show that because of these pressures from big shareholders, companies are not investing as heavily in research and development and other things as they otherwise would be doing. And CSR is part of that story. They're not making those investments either. So in order to, before we can expect corporations to use this legal space that they have to engage in CSR activities, to adopt CSR policies, shareholders, these big institutional shareholders, have got to change their outlook. They've got to be willing to be more patient. They've got to lengthen their own time horizon with respect to getting paid. They need to, in other words, be socially responsible in that sense. The problem is that it's not hard, it's not easy to think that that might happen because, again, it's not a matter of ideology, it's a matter of market pressures, legal obligations. The pension funds have legal obligations to current retirees. They've got to write those checks every month. So they don't really feel that they have the luxury to wait, to be patient, to let the company invest in CSR now for the sake of greater profits, several years down the road. And the same with the mutual funds. They're competing for money. It's a business. They have to invest in companies that are going to generate short-term results as long as it's the retail investors who buy shares of these mutual funds are going to invest in the funds. So that's what I mean by shareholder social responsibility. That's why I think it's an important piece of the whole CSR thing that people haven't really noticed. And it's a hard problem. If you really wanted to tackle that problem and say we're going to put laws in place that require shareholders to hold shares for longer periods of time, things like that, it's not that easy because the reasons for this behavior, again, are complex and not likely to go away. Okay, let me stop. Let me conclude here. It's certainly the case that large corporations have massive potential to contribute significantly to environmental sustainability by doing more than current environmental law and regulation requires. Corporate law is not what is preventing them from doing this. Okay, I want to say that again because it's really important. It's not well understood. Corporate law is not the villain here. It's not why. It is not preventing them from companies from doing more. What I think is, and this may be part of a larger story, but it's an important part, what is preventing them from doing more is pressure from large institutional shareholders, discouraging them from making investments in CSR activities that are only going to generate long-term payoffs. So let me stop there. Is that enough? Did I go long enough? I want to earn my paycheck, but wait, I'm not being paid. Okay, yeah. Thanks.
So do you see a distinction in the situation where there's a more immediate risk to the brand from not acting, which is, of course, our model, but that we're trying to create, or not.
Yeah, that's different. When you have, take for example the Fair Food Initiative that Steve taught us about a few minutes ago. Or, well, actually, no. Here's a better example. Suppose you were an oil company and you're worried about, another oil spill or something like that, which would have devastating environmental consequences. We know that all too well. And so the question is, well, do you take some extra measures to avoid that, or you just simply comply with the law and do what you have to do? Do you do the responsible thing, or do you the goal of minimal compliance? Well, that's different, because there they got to worry about legal liability. They got to worry about major reputational costs. That sort of thing is, I think, is routine risk management now at every big company. They've got to be attentive to worries about consumer boycotts. They've got to be worried about legal liability and other kinds of reputational risks. So they're going to do that. They're going to make those expenditures for financial reasons, because the potential cost is just too great. I'm really talking about initiatives that maybe aren't as obviously necessary, because risk management is a huge part of what people who run big companies do all the time now, and it's much more scientifically organized than it used to be in the past. And reputational risk is big, especially for consumer. Not so much for mining companies, mining companies in particular, because what they don't sell to consumers, what they do takes place behind in remote locations, and maybe NGOs will pick up on it, but even if they do, consumers aren't paying attention. But consumer product companies have to pay a lot of attention, because the biggest threat to them is not legal liability; it's a consumer boycott. I mean, look at Nike's a great example of that. What happened at Apple a couple of years was another great idea, and that's a big part of why Steve has so much leverage with these people, and why the whole labeling thing is going to be important. I didn't even know about it, but I do now. I'm going to pay attention.
We're trying.
Yeah. So yeah, I think those kinds of investments are different because the risk is real. It could materialize soon, and it could actually even destroy a company. So they're going to make those sorts of investments. I think once people find out. Yeah.
And this will demonstrate my lack of knowledge of corporate law. It will more demonstrate. So could a company, so you got shareholders who say, I want profit now, right? Could other shareholders or some other entity besides management, which might get fired, as you point out, defend that on the ground? So suppose what they didn't want them investing in was research and development, like for a drug company, right? So they're selling all their great drugs now, but they don't want to put in anything in R&D, and you know that in 15 years the coverage is going to be bare. Is there some sort of mechanism?
Yeah, so I think here's one way to think about that question. Are shareholders homogeneous in their preference for short-term returns over short-term investments that generate long-term value? The answer is no. I think a lot of people understand this. But the guys who are holding most of the cards are the big, powerful institutions that are under these pressures to insist on short-term results. So if you are somebody who's concerned about that, you're looking, you think, well, not enough investment in R&D, or maybe not enough investment in CSR, rather than trying to organize other shareholders, like-minded shareholders, to put pressure on management, you're more likely to disinvest and invest in some other company that maybe has a different.
But you couldn't sue them for waste, for example.
No, you couldn't. Okay. Yeah, there's no legal remedy there, a meaningful legal remedy. Okay, first Jeff and then Amy.
So I guess the problem you talk about is exacerbated by executives whose compensation is dependent on short-term profits, and so they may do things that benefit them personally that are inconsistent with the company. But pushing back on the other side, I think the point you make, Steve, is a good one. There are lots of shareholder initiatives, and there are pushes from shareholders, and there are pushes from the institutional investors themselves who adopt CSR. Like you've got the Equator Principles, where all these financial institutions are requiring due diligence before they invest to be sure that a company is being proactive and progressive.
Yeah, no, that's quite true. I don't want to suggest that my picture of shareholders and what they want is homogeneous, because there are plenty of shareholders, including major shareholders, that have social consciences or are concerned about the long run health of the economy and the decline in investment in R&D and other sorts of things. So that's true. So it's not hopeless in that sense, but it does seem to me that in the current environment, it's the shareholders who are insisting on short-term results who have the louder voice. In many companies, not all. Companies differ too. Some are willing to take a more patient approach and take a more long-term value approach. Some don't even report quarterly earnings because they don't want to be pressured from investors to meet quarterly accounting benchmarks. So that's a good point. The other point is also good. CEOs and top executives at these big companies are compensated not just with buckets of cash, but also with stock and stock options. And so their wealth is directly tied to the share price. And it incentivizes them to maximize share price in the short term. So it's not just pressure, external pressure. The compensation systems are designed in a way that predictably leads managers at many of these companies to try to prioritize current share price, which is largely in our economy a function of quarterly accounting results. First, Amy, and then you.
So are privately held corporations then, in a sense, leading the way on this corporate social responsibility?
They can. They're certainly, if you have a privately held company as opposed to a publicly held one, which means we have a small number of people who own the stock of the company, it could be a large company. Now they're free to run the company in any direction they want. State corporate law allows them. Actually, that's really what the Hobby Lobby case was about. We're all concerned about the implications of that case for women's reproductive health, issues of that kind. We're also concerned that this religious exemption is going to let companies get away with all kinds of things based on superficially plausible claims of religious liberty. But one thing the court did get right in that case was its conclusion that corporate law does not require, and these are family corporations, who are deliberately pursuing policies that are not profit maximizing, leaving a lot of money on the table for religious reasons. And this is an example of what you're talking about. I mean, these are private companies. They don't have any pressure from big outside shareholders or anything like that, and so they can take the company in whatever direction they want. Are they leading the way? I don't know. In terms of big environmental impacts, there's scale issues. They tend to be smaller companies, and the ones who we are all really worried about are not private companies. Sir.
So I'm curious from your perspective, do you see sort of the divestiture campaigns aimed at institutional shareholders as problematic? I mean, something that's not likely to succeed. And I'm thinking big issues, the global warming issue, the coal divestiture stuff that's sort of going on. Do you think that's not a likely path forward?
You mean trying to persuade big institutional investors to pay attention to these concerns? I think it's, for the pension funds, I think you might get some traction there, because they do have to worry about not just today, which they're very worried about, but they have to worry about 20, 30 years from now. And so they're trying to balance concerns for the long term with concerns for the short term. Gosh, they're under so much pressure right now. I don't know. I think it's hard. I spent a lot of time, I won't tell you who it is or what state, but somebody put me in touch with a guy who ran the public pension fund at a major northeastern state. Because I wanted to, I had this idea and I wanted to get a sense of, what about this? We talked a lot about it, and he said, we're desperate for cash every quarter. And this was a few years back, before the stock market had started to run up again. Things are pretty good at the moment now. They were doing investing in risky things, hedge funds and crazy real estate ventures. They were selling assets to meet their current obligations and all that sort of thing. So pressures are heavy, and even though intellectually everybody, I think, knows that this isn't maybe the best thing for the economy or even for the shareholder itself, it's hard for those countervailing considerations to get a whole lot of traction. Yeah.
EU is introducing mandatory reporting requirements, and I'm wondering if you can speak to whether we've seen examples of that in the United States, or the possibility of those being successful, because they would immediately decrease profits of corporations if...
Well, you mean like reporting on greenhouse gas emissions and that sort of thing? Yeah, I think that, somebody talked earlier about a new SEC requirement I didn't even know about in that area. I don't know, because the point about disclosure is shareholders who care about that stuff will pay attention. But I think my point is that a lot of these shareholders I'm worried about they may care in the abstract, but they don't care when the rubber meets the road, because they're fixated on today and meeting the next month's payroll, so to speak.
But in terms of putting pressure on shareholders to maximize profit, wouldn't mandatory disclosures to consumers, so assuming that consumers are interested in protecting the environment, that could potentially decrease immediate profits and put pressure on...
Yeah, it could. And, a lot of people, and consumers may be the best hope here, because there have been some really great examples of consumers putting pressure on companies to stop doing things that they shouldn't have been doing. And at the end of the day, I think that's really the most powerful
consumer power
arrow in your quiver. So that's important. But you know what? I don't think you need SEC mandated disclosure for that, because there's an NGO industry out there that does a lot of hard work to try to uncover the activities of these big companies and publicize them, because they're trying to make money too, and the more attention the NGO can get, the more donations it'll get and all of that. So I see more hope there. But also remember that some important industries are immune from consumer pressure. And I'm really thinking here more about the multinational mining companies and the oil companies, because the oil companies have to deal with us. But the mining companies don't. And they're out there doing all kinds of things, and nobody even knows what they are.
But who do they sell to? An NGO...
Well, they sell to other big corporations, and there is a way in even with respect to them. This was supply.
Yeah, I haven't figured it out. It just seemed to me that they dig it up because they're selling it to somebody.
Well, they are. They're selling it to other big corporations, and at some point there's going to be a consumer. Yeah. So that's why you're in business. So, even there, I think there's possibility for consumer pressure. But really, the more high-profile things have been companies like Coca-Cola, the problem in India, the oil companies and the horrible things they've done in South America and Africa, and that sort of, and Nike, Apple, consumer products company. Sir.
I heard a presentation a few days ago by a stock analyst, and he said American corporate profits today are at an 80-year high. And the only reason he said he was saying that is we don't have records more than 80 years old. The Dutch have records that are 400 years old. And stock prices, according to that measure, are at a 300-year high. Not stock prices, corporate profits are at a 300-year high. So I guess the thrust of what you're saying is it doesn't matter how well they're doing, the pressure's still the same.
Yeah, I guess, it'd be interesting to know whether the pressure from shareholders has abated over the last couple of years as the stock price market has gone up and up and up. And I just don't know the answer to that. As to why their profits are so high right now, I don't know that either, except, share price is way beyond, they can't really, the multiples of earnings that stocks are trading at now make no sense.
Well, he was talking about corporate profits.
Yeah, you're not talking about share price, you're talking about corporate profits.
Right, he made that, the point you just made, he made that point too, but a separate point he was making was corporate profits.
Well, I don't know.
They've never been probably in Western history.
I think that's probably true, and it's hard to explain. Look, airfares haven't come down, even though fuel costs have come way down.
I guess the point I was referring to is the earlier one. You would think if there were ever a time where the pressure you talk about would be relieved, and there would be more marginal room for that kind of activity, it would be now.
But who has ever said, okay, I have enough? It's not like it's never
that's not America
in the world.
but it's not common.
That may be the point, right?
Yeah, that's
Maybe.
probably,
But it
that
may-
probably is the point.
Maybe. I don't
Okay,
know.
sir, and then Jeff.
My question is, what's changed? Looking back, based on what you said, were there more individual shareholders in the past, and how far back is that? Before?
Well, yeah, I mean, the dominance of institutional shareholders is a recent 20, more or less last 25 years phenomenon. After World War II, it was mostly regular people, you know, so-called retail investors.
Is there anything in particular that changed that?
I don't know, you know, that's a good question. I
Is it
don't
the
know.
401k plans? That
Could be. Could be that. Well, you know, the pension funds, there was a time not long ago when they weren't allowed to invest in the stock market. So all the states changed their laws to allow these big pension funds to invest in stock. Why was that? Because they needed more money to meet their obligations, and it was thought they could get better. Over the long haul, you do get better returns. The stock market and some kind of fixed income investment. So there's that. I don't know. It's a good question.
Yeah, so I was just going to make a comment. I think the point about privately held corporations is an excellent one. I've got a client I love. They're a chemical company. They're international, but it's closely held. There are 200 family members. They all have the same last name. Those are the shareholders.
That's close
And no matter where they are, they go beyond compliance in whatever country they're in. All the shareholders took a hit, so they wouldn't have to let anybody go. When you know the market went, that was just a decision they made. And the higher up people gave money back, so the lower up people would continue making money. So you have those corporations on one end of the spectrum, and then you have some others, like one I mentioned earlier, where they're closely held and they've got a whole lot of money, and their focus is making more money and not doing it.
yeah.
And they're not subject to the same scrutiny, obviously, that
No,
publicly
not
held corporations.
Yeah, that's right. Anyone else? Yeah, Jared.
Yeah. Of the institutional investors, how many, do you have a sense of how many are taking activist roles, getting board seats?
It varies. You know, some of them are very passive, and then the way they put pressure on boards is basically by threatening to sell their stock in the company if the company doesn't meet the quarterly results that the investor expects. Others are more active. They differ, even within particular classes of shareholders, like institutional, like the pension funds. Some are quite active. Some are very passive, even though they have a lot of power. It's surprising. Are you coming up here to not drag me off the stage? I'll go willingly if you want.